Welcome to The Explainer. Today, we're going to dig into a really interesting insight from JP Morgan Asset Management. It's all about this battle between the market's current optimism and a pretty big risk that might be lurking under the surface. So let's get right into it. So right now, if you look at the markets, the general feeling is pretty sunny, right? But what if? What if the biggest piece of the puzzle is something most people are just completely overlooking? That's the big question we're going to tackle today. All right, so first up, let's talk about why everyone's feeling so good. The prevailing view out there is that 2026 is shaping up to be another really strong year for investors. And this whole positive vibe is built on a few key ideas, a few pillars of support. And here's the cocktail, right? It's a pretty powerful mix. You've got the US economy, which looks like it's making a really strong comeback. Then you have government spending, giving things a nice little push, a tailwind. And on top of all that, there's this widespread belief that borrowing costs are just going to keep on falling. But here's the thing. The real linchpin, the one thing holding this whole optimistic view together, is the assumption that inflation is, well, basically dead and buried. And that, right there, that brings us to the market's potential blind spot. Because what happens if that one foundational belief, the one about inflation, turns out to be completely wrong? This quote from the JP Morgan brief really nails it. Here's the risk in a nutshell. What if the very thing that's making everyone so optimistic, a booming economy, is the same thing that could bring inflation roaring back? I mean, it makes sense, right? A strong economy often leads to higher wages, and it gives companies the power to raise their prices. This is the central risk they're flagging. Okay, so to really get why this isn't just some far-off theory, we don't even have to look that far back in history. I mean, let's be honest. Forecasting inflation is, well, it's notoriously difficult, to put it mildly. Okay, take a look at this chart. It tells such a powerful story. Those dashed lines, that's what all the experts thought was going to happen with inflation. Now, look at that solid black line. That's what actually happened. And as you can see, there's a pretty significant gap there. Yeah, this just lays out the problem perfectly, doesn't it? The consensus, all those dashed lines, they just kept expecting inflation to cool off, to fall back down. But reality was that solid line, a massive sustained surge that almost no one saw coming in 2022. It's a really fresh lesson in just how hard it is to predict these kinds of pressures. Okay, so what does this all mean for you, for investors? If we accept that, yeah, an inflation surprise is a real possibility, what does that actually mean for our portfolios? Let's break down the two completely different paths this could take. And wow, it is a stark contrast. It's like two different worlds. On one hand, if the consensus is right and inflation stays low, then yeah, that optimistic case for 2026 probably plays out great for things like stocks. But if the risk scenario happens, if inflation spikes, well, that could be a double whammy. It could put serious pressure on both your stocks and your bonds at the same time. And look, we don't even need to imagine this. It's not a hypothetical. The brief points to a super recent example, 2022. That was the year this exact scenario played out, and it caught a ton of investors completely off guard. So this all leads to a really practical, strategic takeaway from the brief. The idea isn't to just throw out the optimistic view and run for the hills. It's about being prepared. The suggestion here is to think about adding some insurance to your portfolio. You know, assets that might do better if inflation does heat up. They mentioned private market real assets, which actually did pretty well during that 2022 spike. Okay, so with all that context in mind, the optimism versus the risk, let's take a quick look at the market right now. A little snapshot as of early January 2026 and see how some of these themes might be playing out. All right, first up, the S&P 500. It's up 1.8% so far this year. So, that reflects some of that optimism we've been talking about, but it's a pretty modest gain, not exactly shooting for the moon just yet. Next, let's look at the 10-year Treasury yield. It's sitting at 4.17%. Now, this is a really crucial number to watch because it's a benchmark for borrowing costs. If inflation were to spike, you'd expect this number to go up and probably pretty quickly. And this is interesting. Gold, which a lot of people see as a hedge against inflation, is up 4.1% so far this year. Now, that's a pretty strong start, and it could suggest that maybe some investors are already starting to hedge their bets, getting ready for that risk scenario we've been walking through. And that leaves us with this final thought. Following the crowd, sticking with the consensus, it often feels like the safest thing to do. But as history shows us time and time again, the biggest risks, and yeah, sometimes the biggest opportunities, they come from the surprises, the things that consensus just gets wrong. So the key question for you, for any investor, is simple. Are you prepared for the unexpected?